Okay, this is a review of the Chapter 2 transactions. We're going to be going over these 12 transactions that we learned in Chapter 1 and marking those on these T accounts. So before we get started, it's important to understand that the normal balance of all assets is on the left side of a T account. That's the debit side. So notice the asterisk is marking the normal balance. That's the side the account goes up on. So the arrow is showing up on that side. Opposite of the normal balance is the side it goes down on, so all assets go down with credits. Debits on the left, credits on the right. Coming over here to liabilities. Liabilities, normal balance is on the credit side. They go up with credits. Notice the arrow going up. And opposite of the normal balance side, they go down. So debits make accounts payable liabilities go down. Credits on the right side make accounts payable liabilities go up. Owner's equity has a normal balance on the credit side. So good things to owner's equity have a normal balance of credit, capital, investments into the business would be recorded here. Normal balance of credit goes up with a credit, down with a debit. Same for sales. Sales are good for a business. It adds value to your business. So sales, normal balance credit, goes up with a credit, down with a debit. The only other accounts that you need to account for are the negative accounts to owner's equity. These are your expense accounts and your drawing account. These have a normal balance of debit because as they go up, it in turn will make owner's equity go down. Okay, so you got to kind of pay attention to that. As expenses and drawing go up, it'll make owner's equity go down. So they have a normal balance of credit as marked with the asterisk. They go up on that side, down on the opposite side. Okay, first transaction, receive cash from the owner as an investment. Receive cash from the owner, let's just say it is $10,000. To make cash go up, you would debit cash because its normal balance is on the debit side. You don't owe money that you just invested into your own business. It will get recorded directly in capital as value you have in the business. That's your ownership of the business. So of the $10,000 you put in, you own it all. From this point forward, the only thing that gets directly transactions get directly put into capital are investments. Sales go into sales now, and all expenses and drawing have their own accounts. So only investments into the business will have capital going up now. Okay, paid cash. Paid cash for supplies. Next transaction, we're going to pay cash. Cash goes down. Let's say we paid $200 in cash. Cash will go down with a credit, opposite of the normal balance side. We bought supplies. Supplies goes up with a debit. That's $200. There's your debit. There's your credit. We'll get you watching. Okay, so this is cash going down makes assets go down, then supplies going up makes assets go up. That's the wash. Asset balance didn't change, just the ownership. The value is shifted from cash to supplies. Okay, next transaction. Bought supplies on account. Bought supplies on account. Supplies will go up. Let's say we bought another $150 in supplies. Supplies goes up with a debit. We bought it on account. Let's say we bought it on account from ABC Company. So accounts payable, ABC Company. We owe them money. We owe them $150. So this is a record you owe them money. Goes up with a credit. There's your debit. There's your credit. Always got to have one debit and one credit until told elsewise. As supplies goes up, assets goes up. As accounts payable goes up, liabilities go up. Opposite sides of the equal sign, the classifications move together. All right. Paid cash on account. Cash will go down anytime you pay cash. Let's say we pay off $100 that we owe. Cash will go down with a credit of $100, making assets go down $100. You're paying on account, you're paying off money you owe. So accounts payable will be impacted. We want to record that we do not owe that money anymore. So we want to make the account go down $100. So we're going to debit it to make it go down. Accounts payable goes down with a debit, making liabilities go down. Cash goes down with a credit, making assets go down. Opposite sides of the equal sign, classifications move together. Okay, next transaction we're going to do is bought insurance on account. We'll make insurance go up. We bought it on account, so accounts payable will go up. Insurance right here, bought insurance. Let's say we bought $300 in insurance. Insurance goes up with a debit. Normal balance side makes asset go up. Debits to assets will make the asset classification go up. Bought it on account. We bought it from, let's say, XYZ company. We owe them $300. That's your credit. Makes this account go up. Accounts payable goes up. Liabilities go up. Assets and liabilities moved in the same direction. Insurance went up. Accounts payable went up. There's your debit. There's your credit. Other way you can pay for something is paying cash directly for it instead of buying on account. So let's buy some more insurance with cash. Let's say we bought another $50 in insurance for whatever reason. Insurance goes up another $50 right here with a debit, making assets go up. We paid it with cash, so cash needs to go down. Cash goes down with a credit. Assets is a wash. It went up and down the same amount of $50. Seventh transaction, receive cash from sales. This is the 2-3 section. So if you missed 2-3, this is the section you'd want to pay attention to. Receive cash from sales. Let's say we made a $2,000 sale for cash. Cash goes up with a debit, $2,000. From now on, sales is recorded in the sales account. The only thing recorded directly from a transaction would be an investment into capital. Sales goes up with a credit, just like capital goes up with a credit. $2,000. There we go. Sales goes up $2,000, making owner's equity go up. Assets goes up with $2,000 because cash went up. Sold services on account. This is the other way to make a sale. You just don't get paid cash directly right then. You have to set up an accounts payable. Sold services on account. Because of realization of revenue, we count the sale at the time of the sale. So let's just say we made a $1,000 sale to a company. We count the sale $1,000. It's a credit. Credit makes owner's equity go up. We did not get cash for it. We got to set up an accounts receivable. Let's just say it's this company one that bought on account. $1,000. That's your debit, making accounts receivable go up. Your credit, sales, $1,000, making sales go up. Assets, owner's equity, both go up. They move in the same direction, opposite of the equal sign. Okay, receive cash on account. So company one is now going to pay us. It's maybe a week later. They're sending us some of the money they owe us. So this company, they owe us $1,000. Let's say they are sending us $400 of that money. We need to record that they paid us $400. They don't owe us that anymore, so we need to do a credit to make accounts receivable go down $400. We got that cash that they owed us. So we're going to come over here and say we got $400 cash. Cash goes up. With a debit of $400, accounts receivable goes down. With a credit of $400, assets remains unchanged. It's a wash. It goes up and then down. All right, 3 transactions left. Paid cash for rent. The last 3 transactions are all paid cash, so they will all be credits to cash. Paid, let's say, $500 for rent. So cash goes down with a credit, $500, making assets go down. Coming over to this side, owner's equity will go down. We don't mess with the capital account for expenses. All expenses will have their own expense account, and if not, there will be a miscellaneous account. Okay. In this case, it was rent. Rent goes up, the amount that we paid to rent, $500. As rent expense goes up, owner's equity will in turn go down. As cash went down, assets went down. So the classifications, assets and liability, owner's equity, both go down. They're opposite of the equal sign. So cash went down, assets went down, rent expense went up, making owner's equity go down. They both went down. Okay, pay cash for telephone bill. That's an expense. If you don't have a utility expense, you got to find an expense account that it would go into. In this case, I have a miscellaneous. Let's say we paid $75 for our utility bill, our phone bill. $75. Miscellaneous expense goes up 75, making owner's equity go down. We paid cash. We're coming over here. We paid $75 cash for that expense. Cash goes down, assets goes down. Cash is your credit. The expense being paid is your debit. Oh, I'm sorry, right here, 75 is your debit. There's the debit. There's the credit. Paid cash for an expense. The last one is owner takes out money for personal use. This is your drawing account. It's similar to expenses, but it is not an expense account, but it impacts owner's equity the same way. As it goes up, it will make owner's equity go down. Let's say we took out $50 for personal use. The owner wants to use that $50 for whatever they want. The drawing account goes up $50 to record money was taken out for personal use, making owner's equity in turn go down. We paid cash. It was $50. Cash goes down $50, making assets go down $50. Your credit was cash, and your debit was drawing for that. All right, those are the 12 transactions. Hope this helps.